This is All India Radio. In the program Spotlight Now, we bring you a discussion on RBI's decisions and its impact on economic growth. The participants are Shubhamoy Bhattacharjee, economic analyst, and AIR correspondent Renu Kataria.
The Monetary Policy Committee MPC slashed the repo rate by another 40 basis points from 4.4% to 4%. Why did the RBI cut the interest rates?
RBI, as the controller of the monetary policy, the principal way in which it can affect how the economy moves is through the change in the interest rate at which banks borrow money from the RBI. So what happens is that when RBI wants to make the flow of money easier or cheaper in the economy, then it cuts the interest rate. In this particular financial year, that is speaking from end of March till now, the RBI has cut the cost of money by 115 basis points to ensure that the money that is available to the banks will be available at a cheaper rate, which would make them interested in giving out loans to the people at an equally cheaper interest rate. The reason for that is that right now we are facing a huge disinclination by industry, by services, and by just about anybody to take out any loan to start or renew the businesses that they are engaged in. The RBI hope that by cutting the rate of interest, the business would be interested to again start doing their work by taking out cheaper loans and starting their commercial work.
Also, the moratorium on term loans available till 31st May was extended by another 3 months till August 2020. What will be the impact of this?
The RBI had announced in March that all interest payable on any sort of loans taken out from the financial sector will be given a moratorium. What does this mean? That for the next 3 months, that is April, May and June, no company, no individual, no MSME will have to pay back the interest on the principal for 3 months. At the end of the 3 months, however, entities will have to pay back the accumulated rates of interest and, if necessary, the principal also, depending on the schedule that they have agreed to with the financial entities like the bank or NBFCs with whom they have taken out the loan. Given the current situation where the lockdown has got extended for so long, not been possible for most business to resume normal activities. In this condition, the RBI felt that it was necessary that the same forbearance that it has shown earlier should be now be extended for another 3 months up till the end of August. The RBI, in fact, has gone one step better. What it has said is that not only will the moratorium be available till then, but the interest that has become due will not have to be paid back at one go. Instead, it has urged the financial entities to agree to space out the payment of the interest over the rest of the financial year. So that means there is no interest waiver, but the interest has been deferred for the people who have taken out any loan. This is important because a large percentage of any business, and that is from small to large, take out loans to do their business. Current condition, it was very difficult for them to be able to pay back when no production, no services was happening in most of the businesses, and even those where this work has started, it is still at a very, very nascent stage.
India's repo rate cut is in line with the rate cuts announced by developed economies like the USA and UK. Do you agree, sir?
The rate cuts by RBI is definitely more or less same pattern in which other major economies like USA, UK, EU have been cutting the rates of interest. And that is expected because in the recent decades, the world has come to expect that the central banks will basically make available money at a cheap rate for the people to do their business. So definitely it is necessary, and yes, it is definitely on the same lines. In fact, it would have been very risky if RBI had decided to wait and watch. Because what would have meant is that while the entities in the rest of the world are getting their money on easier terms, any business in India would have to face a costlier rate of interest. And that would have definitely meant worsening their competitive edge. It would have meant that every individual, every company, every business which takes out a loan from the banks was being told that they have to handle the fact that the money will be more costly in India compared to the rest of the world, and it would have definitely further worsened the current economic crisis that is going through in India.
Talking about the real estate sector here, sir, the RBI measures to reduce the repo rate and reverse repo rate is in confirmation of the government policies to build liquidity and enhance its circulation in the system. How will this help the real estate?
The real estate sector has got more than the liquidity problem. The real estate sector's problem is obviously to some extent that they have to bear with a high rate of interest. In most of the sectors, the sale and purchase of properties is financed through loans from banks or NBFCs or from the housing finance companies. So to that extent, definitely the RBI offer of cutting the repo rate helps them. It also helps that if the banks do not park their money that is there with the RBI to earn extra rate of interest. So how it works out is that RBI has not only made money cheaper, it has also made it a bit more difficult for banks to keep the money with RBI, because RBI has cut the rate of interest it offers to banks for keeping unused balances with it. So therefore the banks have to go out and offer loan to whoever. The real estate sector is one of the largest borrowers from the banks. So the banks will be a bit more willing to give out loans to the real estate sector. However, the real estate sector has got much more problem than just the availability of money. The real estate sector's problem also stems from the fact that many of the properties that they are built up doesn't have it because demand condition in the economy does not encourage people to buy properties. There are lots of business which are finding they will not need the space that they had bought when work from home is started. It is also the fact that many of the shops and other establishments which are opening up will initially not be very keen to add to the space that they have to buy it, to get more real estate. So the real estate sector, which depends on what is called animal spirits in the economy, is definitely in a larger problem compared to the rest of the economy, and therefore they are facing one of the worst ends of the crisis.
So we are talking about extension of the moratorium. What is the significance of extension of moratorium and what impact will it have on the banking sectors?
The banking sector will obviously have to be very careful from here. In fact, yesterday, after RBI's announcement, the finance minister met the chairman of the public sector banks. The public sector banks are held by the central government. So as the principal shareholder, finance minister was discussing with them what measures they should take. Remember, the banks, while they will be offering moratorium on loans, it means that essentially the banks have an added pressure now. How is that so? Because banks make their earning from the interest that they charge on the loans that they give out. If there's a moratorium, and if more and more people take those moratorium, and the moratorium gets extended, then that means the income of the banks get lower. While the income of the banks get lower, the expenditure of the banks don't get lower, because banks still have to pay interest rate on the interest on the deposits that they hold, and the deposits come from you and me and from anybody else who has parked money with the bank. And banks cannot refuse to park money that anybody comes to park. So the bank's expenditure not only stays, but it keeps on rising as proportion of their total cost of running business, whereas the income that they could generate comes down. And this comes down because not only while there is no waiver, it is the payment of interest stretched out over a longer time horizon. This is a problem of what is called an asset liability mismatch of the banks, and which means it difficult for the banks then to offer softer interest rate for new business. They have to cover their costs. So they are faced with more than one problem, and this is what is typically what is occupying the banks and making it difficult for them, particularly when they know that they are also sitting on a huge non-performing asset, which is about 12% of the total bank credit. And that problem was just started getting solved to some extent before this COVID-19 crisis came along. So to add to their weak balance sheet, the fact that their income has further deteriorated in this condition makes it a double whammy for the banks, which will take a lot of time for them to come out of.
Mr. Shaktikanta Das also said that the GDP growth would remain in negative territory with some pickup in the second half. What measures will revive the growth over here?
One of the measures that he's already talked about is obviously to make the cost of money cheaper so that more and more people take out loans from the banks and the NBFCs to restart their business. We have noticed that the states have started to reduce the intensity of their lockdown. The more and more business have started to open. As these businesses open, they will need working capital. And going for a small business and for large business, instead of going to unorganized sources, it is obviously much better to go to a bank. Especially because the government has said that the credit to the small enterprises will be given without any demand for collateral, which is a very positive move. What Mr. Das, as the governor, is hoping is that this demand will start deepening and expanding across different sectors. When it does so, it makes it easier for banks start earning credit because the new business will obviously not be asking for interest forbearance but will be happy if they can get their borrowing at a softer rate of interest. These sort of measures, along with the fact that when the economy starts moving for different sectors, then one would expect that there would be certain further demand for money. For instance, airlines will start their operations from Monday. We also expect other sectors to start operating, even if not at full capacity, but at least at some capacity. There are demand coming from the e-commerce companies as well as other sectors of the retail who will be where there is, we've noticed, a fairly sustained demand for transport of goods and services. Similarly, there will be a demand for crop loans because this year the monsoons are expected to be on time. So that should push up demand from the loans from the agricultural sector as farmers go out to plant the kharif crops. So altogether, these are the measures that should help the economy, but certainly these will not be adequate because after 2 months of absolute standstill, the economy has lost a lot of what is called permanent output, which means that of the 12 months which the economy could have produced goods and services, 2 months have been irrevocably lost. It is not possible to bring back the output of those 2 months, so there's a permanent shock to the economy, and that shock will get reflected in the contraction of the GDP, which will be for over 40 years as far as India is concerned.
Mr. Shaktikanta Das also mentioned that margins for working capital are to be restored to the original level. How will the RBI do this?
Basically, what the RBI wants is that the banks should not ask for additional collateral or additional margin. What is the margin? Margin is that when a business comes to a bank to borrow some money, the bank asks for a margin. It is a sort of a safety net which the banks maintain. What the RBI has saying is that this bank should not, under the current circumstances, there were lots of other additional, what I might call strictures or additional rules which the RBI had put in for banks when in giving out loans to different sectors. Those loans and those ones will not be operative for most business because that is what will be necessary for business to be able to work right now. They should not be sort of what I should call be asked to provide additional margin facilities, which means that there will be not only longer moratorium, but the payment of the working capital interest will also be paid through as installment. Right now what happens is that working capital, for instance, which the business borrow, have to be paid off earlier compared to, say, a term loan. Those sort of things becomes difficult for business to comply with in the current condition. So RBI is essentially sort of easing out the rules for all sectors in the dealings with the bank to ensure that the cost of their capital comes down and they are able to start business and offer goods and services to the people, so that people are also encouraged to buy despite the lowering of their income and the economic activity starts spiraling up.
Thank you, sir. Thank you for joining us today.
Thank you.
You were listening to a discussion on RBI's decisions and its impact on economic growth. The participants were Shubhamoy Bhattacharjee, economic analyst and AIR correspondent Renu Kataria. This program was produced and presented by the News Services Division of All India Radio. You can listen to it on our mobile app, News on AIR. This program is also available on our website, newsonair.com. You may email your opinion about this program at airnsdtalks@gmail.com.